Hello and welcome to Money Talks, and I'm delighted to be joined by IB Times financial expert Edmund Shing. Welcome, Edmund.
Hello, Alfred.
And this week you're going to be talking about hedge funds.
That's right, Alfred. So hedge funds, I should probably explain to the viewer what a hedge fund is. Hedge fund basically is a fund designed for pretty much very rich people, and they typically take a little bit more risk than the average fund and also invest in strategies which an ordinary unit trust or pension fund would not invest in. So very much a specialised fund run by specialised people for rich individuals.
So it's designed for wealthy, extremely wealthy individuals, and yet you'd say, based on recent figures, that they're not really worth the investment.
Absolutely. Well, if you look at the performance this year of the average hedge fund has turned £100 at the beginning of January to £98 today, right? So you've lost £2. Not great. You might say, okay, so never mind, Edmund, over the longer term, they must have done well. Well, actually, since 2011, your £100 at the beginning would have turned into £99. If instead of investing in hedge funds, you had invested in the FTSE 100 in a tracking fund, your £100 would instead have transformed into £133 today. So actually, hedge funds, whether you look in the short term this year or the longer term since 2011, have been poor investments.
And why is this? What's the moral we can learn?
Well, what I always say, Alfred, is very simple. Hedge funds sound very sexy and they sound very complicated, but actually, generally in investment, simplicity is key, and actually lower cost is key, because the one thing you can never control with a fund is the investment return, because sometimes it's high and sometimes it's low. But the one thing you can fix from the outset is the cost, what it's going to cost you, the investor. So generally, the lower the cost, the better the after cost returns to you, the investor. So hedge funds are at the wrong end of that. They're expensive. They often charge 2% management fee and even something called a performance fee. If they do well, they even take more money off you. So actually, great deal for the hedge fund manager, which is why so many of them are so rich. Not such a good deal for the investor. So for the average investor, stick to an index tracking fund, which is very low cost, like an exchange traded fund.
And if you wouldn't recommend investing in a hedge fund, then what would you recommend that we invest in?
Well, rather than invest in a hedge fund itself, I would invest in the underlying companies. There is one listed in the UK called Man Group, and this is a group of hedge funds such as GLG, AHL, and actually these hedge funds under the Man brand have done quite well this year. This is a stock that is very big, manages $79 billion of assets, has actually good valuation, below, a PE ratio below that of the FTSE 100, and a nice dividend yield of over 4%, so it gives you a nice income stream. So that, I think, is a good way. Buy the stock rather than the underlying funds. The other option would be to buy Aberdeen Asset Management Group, which is a more traditional asset manager of things like unit trusts. Now, they're interesting because they also own things like Scottish Widows, the insurance company. They've actually done well in the past through lots of acquisitions. They've been suffering recently because they have emerging market exposure, which has done poorly. However, I think that this company could get taken over. So again, there is not only a very high dividend yield of nearly 6%, very good income to come from Aberdeen, you also have potential speculation over whether it could become a takeout target or not.
Well, thank you very much, Ed.
Thank you, Alfred.
Well, for the latest business news, go to our website, ibtimes.co.uk.